The Supreme Court verdict in the Adani-Hindenburg case noted that both the center and SEBI were planning to put restrictions on short selling. Just 2 days after the verdict, SEBI, the Securities and Exchange Board of India, updated its framework for short selling. A key change is that SEBI has brought back the disclosure requirements for short sales. Shorting is selling a security, a stock or a bond that you don't own. This is perfectly legal in most financial markets around the world, and there are procedures that investors need to follow to take a short position. This typically happens when the investor thinks that the stock price is currently too high and it's likely to go down. Then they want to sell at today's high price and buy back later at a lower price to make a profit. Both institutional and retail investors have to disclose that they are taking a short position. Further, brokers will have to report stock-wise aggregate short positions to the exchanges. The stock exchanges will be required to publish consolidated stock-wise short positions on a weekly basis. Having information about which stocks are heavily shorted would lead to the price of that stock dropping. This is in line with the short sellers' expectations. Except in the case of manipulation, this is exactly the purpose of allowing short selling, to get these negative expectations reflected in prices. Thus, disclosure will expedite this process of price discovery, which is good. However, there is a caveat. Short sellers also have to close their positions later. This exposes them to the risk of a coordinated attack by optimistic investors who want to push the stock price up, something known as a short squeeze. This happened to an American stock called GameStop in January 2021. Disclosure makes this risk greater, as now optimistic investors know which stocks to target. This risk may deter short selling, thus hindering the price discovery process. SEBI may want to keep an eye on short selling activity and short squeezes to identify price manipulation. Another possibility is to reduce the frequency of reporting by stock exchanges from weekly to say monthly, or require them to report with a delay. Both these approaches will reduce the risk of short squeezes and encourage price discovery through short selling.